Hi, my name is Griffin Sheehy, and I'm the portfolio manager here at Willow Creek. Today, we're going to start with a high-level overview of where the major market indices ended the quarter and touch on how this affected long-term returns. Then, we'll take a look at a slide that discusses recent market volatility and why it's important to remain invested for the long term. Let's dive in.
Let's start off with our first slide here. When we look at these returns, we want to focus on the points that hit our underlying investment philosophy, specifically allocating to a global portfolio of stocks. The US represents about 2/3 of total publicly traded stocks, which means that international and emerging markets make up the other third combined. Global real estate is pulled out by itself because we can think of publicly traded REITs as having characteristics of both stocks and bonds based on the nature of its underlying cash flows. The split there is 3/4 US and 1/4 international. Now, why does this matter? The easy answer is to just say diversification. Here's the more complete answer. When you look at the quarterly returns for each sub-asset class, you'll notice that for the same period they have differing returns. This helps smooth the ride in the short term because they aren't all perfectly correlated to one another. For example, when the US is up 11%, international is up 12%, the effects become smoothed out in the portfolio as a whole. When returns fall, this is also true. Keeping this in mind will help you stay invested during times of high market volatility because stocks as a whole tend to rise in the long term. Keep the general direction of these quarterly figures in mind so that you can think back to it for the next slide I'll go over. This next one here shows annualized returns up through 20 years. This is why we hold stocks for the long term. The second quarter was another extremely volatile one, and when markets go up and down, it can feel like a wild ride. I completely understand that. But when we zoom out to see how this affects our long-term plan, we find they're still on track with our original goals. Even with that volatility last quarter, we can see that long-term returns regained their footing and are still largely positive. The takeaway here is to not make decisions based on what happens in the short-term news cycle, especially when the time horizon built into your plan is looking long-term and takes that volatility into account already. Remember this, stocks will be more volatile by their nature because the role they play in the portfolio is to outpace inflation, whereas the role bonds and real estate play is capital preservation and income. This also balances out short-term volatility from stocks. I thought this slide that came across my desk is timely. There's a famous phrase that says time in the market beats market timing. I'll elaborate. Trying to time trades to the ups and downs of market movements is near impossible to consistently achieve. This slide from our friends at Avantis Investors shows how unpredictable it can be and the pitfalls of getting it wrong. The VIX is an index that tracks volatility, so when this number goes up, that means the lows are lower and the highs are higher. That shows up here with the lowest trading day of the year on April 4th at about -6% and the best day at about 9.5% on April 9th. The typical pitfall is that as the market swings down, nervous investors will sell at the low and then feel more comfortable to buy back in as they see the market move back up. By that point, they've missed the recovery. And in this case, if they stayed out of the market for less than a week, they've missed the best positive day since 2008 for the S&P 500 per Avantis. So now you've effectively sold low and bought high. Not a typically winning strategy. I do sympathize with why though. It can feel extreme in the present moment when the market swings wildly. I mean, just look at the first half of the year. A wild ride to say the least, and that's why remaining focused on the long-term picture can help take the sting out of the short-term swings.
Thank you for joining me, and I hope you found those charts to be insightful and interesting. If you have any questions, please don't hesitate to reach out to me or your advisor, and we'd be happy to have a deeper conversation. Thank you.